3 days ago, Yasir Al-Rumayyan stood before an audience of European financiers and sovereign fund managers at the Rome Cavalieri, Waldorf Astoria, and said, calmly and without apparent drama, that European regulation was, and I am using his exact words, really hurting investors. He went further. He said the Public Investment Fund of Saudi Arabia was thinking seriously about the ability to sustain its European investments. He was not issuing a threat. He was stating a condition. The man who controls the world's largest sovereign wealth fund, $925 billion in assets, the #1 ranked SWF on the planet, was in Rome to announce 140 investment opportunities worth €10.4 billion through 2030. He arrived as a creditor, not a supplicant, and he left the room having made the terms of continued engagement perfectly plain. This episode is about how a man from a provincial capital in central Saudi Arabia came to be in that room, speaking on those terms. It is about one of the most consequential capital allocators of the past decade, and it is about what the scale of that capital actually means. For markets, for the institutions that deal with PIF, and for the architecture of global finance. This is the universal owner. Yasir Al-Rumayyan was born in 1970 in Buraida, the capital of Al-Qasim province in north-central Saudi Arabia. Al-Qasim is not the Riyadh of the international business class, nor the Jeddah of Red Sea commerce. It is a conservative agricultural heartland, historically known for dates and wheat, for a certain directness of manner, and for producing a disproportionate number of Saudi Arabia's religious and merchant establishment. If you want to understand something about the studied seriousness Al-Rumayyan brings to every public appearance, start there. He studied accounting at King Faisal University, a practical, rigorous discipline, well suited to a young man who would spend the next 3 decades building financial institutions from the inside out. His first significant role was at Saudi Hollandi Bank, where he worked in cross-border investment operations. The bank, a joint venture between a Saudi holding group and ABN AMRO, was a genuine interface between Gulf capital and international markets. Al-Rumayyan learned early what it means to operate at that seam, where domestic mandates meet global counterparties, where regulatory frameworks differ, and where the quality of institutional infrastructure determines whether capital moves at all. That operational education proved formative in ways that became visible only later. When the Saudi government moved in the early 2000s to build a regulated capital market, a system with formal rules, licensed intermediaries, and enforceable securities law, Al-Rumayyan was on the founding team of the Capital Market Authority. The CMA did not build on existing foundations because there were almost none. It built the foundations themselves: exchange rules, disclosure requirements, the licensing of brokers and advisors, the gradual opening of the Saudi Stock Exchange to foreign participation. Al-Rumayyan was present for all of it. This is the part of his biography that institutional investors rarely discuss, but that explains almost everything about how he later ran PIF. He did not arrive at sovereign capital as a deal-maker. He arrived as a systems architect, someone who understood, at a granular level, how regulated markets are constructed, what makes them credible, and what happens when the institutions that underpin them are absent or weak. He eventually moved to the private sector as CEO of Saudi Fransi Capital, the investment banking arm of Banque Saudi Fransi, and then, at some point in his 40s, he went to Harvard Business School. The sequencing matters. Harvard came after 2 decades of operational experience, not before. Whatever the program sharpened in him, it was sharpening something that was already there. By 2015, he was 54 years old in terms of professional experience, if not in years. He was appointed governor of the Public Investment Fund that year. The 30-year apprenticeship was over. To understand what Al-Rumayyan inherited in 2015, you have to understand what PF was before he arrived. It was not, by any serious global standard, a sovereign wealth fund. It was closer to a domestic holding company, a repository for government stakes in Saudi state enterprises, managing roughly $150 billion, almost entirely inside the kingdom. It had positions in Saudi Basic Industries Corporation, in Saudi Telecom, in the National Commercial Bank. It did not have a global mandate. It did not have a global portfolio. It did not have an internationally competitive investment team. Then came Vision 2030, Crown Prince Mohammed bin Salman's program to restructure the Saudi economy around the assumption that oil revenue alone would not be sufficient to sustain the kingdom's fiscal position in a world of volatile prices and accelerating energy transition. PIF was assigned a central role to become the fund that would capitalize the new Saudi economy, attract international partners, deploy capital across global asset classes, and return dividends, both financial and economic, that would reduce the state's dependence on petroleum. The transformation Al-Rumayyan oversaw in the decade that followed was, by the numbers alone, extraordinary. $150 billion to $925 billion, a domestic holding company to the world's largest sovereign wealth fund. That is not incremental institutional growth. That is a fundamental rebuilding of what the institution is. Some of the most discussed early moves came in technology. In 2017, PIF anchored the SoftBank Vision Fund with a commitment of $45 billion, at the time the largest single institutional commitment to a technology investment vehicle in history. The bet was on Masayoshi Son's thesis that artificial intelligence would restructure every major industry, and that the firms which controlled critical AI-enabled platforms would generate outsized long-term returns. The Vision Fund's record was, to put it gently, uneven. Many of its portfolio companies, WeWork most visibly, collapsed into financial restructuring or outright failure. But the investment established PIF as a counterparty that global fund managers and technology executives had to take seriously. It announced that Saudi capital was not merely available, it was willing to lead. Other technology positions followed. PIF took a stake in Uber before its IPO. It became a significant shareholder in Lucid Motors, the electric vehicle company, which received manufacturing investment from PIF, and became something closer to an industrial policy instrument than a pure financial holding. In gaming, the fund built positions in Nintendo, Electronic Arts, and Take-Two Interactive, a bet on interactive entertainment as a long-duration cultural asset with global reach and demographic tailwinds. On the domestic side, the scale of the Geiger projects PIF is financing has no real precedent in modern capital markets. NEOM, the proposed linear city in the Tabuk region, the project that has drawn more international commentary than any other element of Vision 2030, is a PIF project. So is Qiddiya, the entertainment destination outside Riyadh. The Red Sea project, developing resort infrastructure along the Saudi coastline. Roshan, the residential development company, attempting to address a structural housing deficit in Saudi cities. These are not financial investments in the conventional sense. They are capital-intensive bets that the physical and economic infrastructure of a new Saudi Arabia can be built within a generation. Al-Rumayyan has spoken publicly about the pace of this transformation with a certain measured pride. The fund's 2026 to 2030 strategy, approved earlier this year, maintains the global mandate while deepening the domestic focus across 6 priority sectors. The architecture of the machine is complete. Now it runs. In 2019, Al-Rumayyan added a second title to his portfolio: Chairman of Saudi Aramco. This is worth sitting with for a moment, because the sheer concentration of institutional responsibility it represents is unusual even by the standards of sovereign capital. On one side of the ledger, governor of a $900 billion sovereign wealth fund responsible for deploying Saudi capital into global markets. On the other, chairman of the most profitable company in the history of capitalism, the entity whose dividends represent the largest single source of PIF's capital formation. Aramco is not merely a large oil company. In the years since Al-Rumayyan took the chair, it has been, by most measures, the most profitable corporation on earth. Its net income in peak years has exceeded $100 billion. Its dividend commitments to shareholders, including PIF, run to tens of billions annually. The fund that Al-Rumayyan runs is, in a very direct sense, downstream of the company he chairs. December 2019 brought the culmination of years of preparation, the Aramco IPO on the Tadawul, Saudi Arabia's domestic stock exchange. It raised $25.6 billion. The the largest IPO in history at that point. The company's valuation briefly exceeded $2 trillion, making it the largest company in the world by market capitalization, surpassing Apple. The listing was not without its complications. International institutional investors had pushed back on earlier valuation expectations. The final listing was domestically weighted, with significant participation from Saudi retail investors and regional institutions. But the outcome, a Saudi state enterprise listed on public markets, with a disclosed financial record, a board structure, and shareholder accountability, represented a structural change in how Aramco could be perceived and governed. Al-Rumayyan managed both sides of that transaction simultaneously. As PIF's governor, he was the beneficial recipient of the proceeds and the subsequent dividend stream. As Aramco's chairman, he oversaw the preparation and execution of the listing itself. The dual role has continued. It is a governance arrangement that would be unusual in most jurisdictions. In the context of Saudi Arabia's political economy, it is the arrangement that makes the Vision 2030 financial architecture coherent. In October 2021, PIF acquired Newcastle United Football Club for £305 million. Al-Rumayyan became chairman of the club. The acquisition was not primarily about football returns. The projected financial case for Premier League ownership at those valuations is plausible but not exceptional. What the Newcastle deal represented, and what PIF's subsequent moves in sport and entertainment represented, was a deliberate expansion of the fund's profile into domains where financial returns and reputational positioning are intertwined in ways that balance sheets cannot easily capture. Live Golf was the most ambitious and the most instructive of these ventures. PIF committed $3.7 billion over 5 years to build a rival golf circuit, recruit the world's top players, and challenge the dominance of the PGA Tour. Al-Rumayyan became chairman of LIV Golf. The enterprise attracted players. It attracted controversy. It attracted serious scrutiny of the motivations behind a sovereign wealth fund's decision to spend billions subsidizing a sport that was already well served by its existing governing structure. The losses were real. More than $1 billion confirmed. The strategic logic that a PIF-backed tour would eventually extract sufficient broadcast rights revenue and sponsorship to become self-sustaining failed to materialize on the timeline required. In April 2026, PIF announced its withdrawal from LEV Golf. Al-Rumayyan stepped down as chairman. The circuit will continue under different arrangements, but the billion-dollar bet on using professional sport as a vehicle for sovereign capital deployment delivered a clear result: a significant financial loss and a complicated public record. What does sovereign capital learn from an experience like LEV Golf? Several things. First, that the regulatory and governance environment of established sports organizations is more resistant to disruption than early analysis suggested. The PGA Tour, under competitive pressure, did not collapse. Second, that the reputational dimensions of sport ownership in democratic markets are not merely an external relations problem. They interact with the fund's ability to attract co-investors, talent, and institutional partners in other asset classes. Third, that the arithmetic of soft power investments must eventually be settled in conventional financial terms. A billion-dollar loss is a billion-dollar loss, regardless of what diplomatic or cultural objectives it was meant to serve. Al-Rumayyan has not spoken extensively in public about LEV. He did not need to. The withdrawal spoke clearly enough. Newcastle United remains in the PF portfolio. The fund has not walked away from sport. But the LIV chapter has almost certainly recalibrated how PF approaches unconventional asset classes where the definition of return is contested. Back to Rome. On June 17th of this year, Al-Rumayyan addressed the FII Priority Europe Summit at the Waldorf Astoria. He spoke about the €98 billion PIF and Saudi sovereign capital have deployed in Europe and the United Kingdom since 2017. He cited €70 billion in GDP contribution. He announced 140 investment opportunities through 2030. And he said clearly that European regulation was hurting investors and that PIF was reconsidering whether European deployment was worth sustaining at current terms. Read that in context. This is not a threat issued from a position of need. PIF has options. The fund's 2026 to 2030 strategy explicitly upgrades its global mandate. Europe is one allocation decision among many. Against the backdrop of an ongoing Strait of Hormuz closure, Al-Rumayyan also took the opportunity to note that Saudi Arabia's East-West pipeline has served as a critical alternative route for global energy flows. He was not being subtle. The message was, "We are a stabilizing force in the system you depend on, and the terms of our participation in your capital markets are subject to review." For institutional investors tracking sovereign capital flows, the Rome speech is a data point worth encoding carefully. PIF is not in retreat. It is in the process of renegotiating the terms of its international presence with Europe, and by implication with any jurisdiction that underestimates the leverage that comes with deploying capital at this scale. What should senior investors be watching in PIF's next phase? 3 things. First, the domestic build-out. The Geiger projects and the 6-sector focus of the 2026 to 2030 strategy represent the largest single test of whether sovereign capital can credibly substitute for private market development at national scale. The outcome of that test will shape how other sovereign funds in the region think about their own domestic mandates. Second, how the fund rebuilds its global technology portfolio in the post-Vision Fund era. The SoftBank commitment was a single large bet. The next chapter will likely be more distributed, more direct, and more focused on sectors where Saudi Arabia has genuine strategic interests. Third, succession and institutional continuity. Al-Rumayyan has been governor for 11 years. The fund he has built is larger and more complex than any single individual can sustain indefinitely. How PIF manages the transition, when it comes, will be as significant a test of institutional maturity as any investment decision it makes. $925 billion, the world's largest sovereign wealth fund, 11 years under one man's stewardship. In Rome, he spoke as a creditor. That is the $925 billion question every institutional investor should be sitting with. When capital at that scale conditions its own deployment, who exactly is negotiating with whom? This has been The Universal Owner. I'm your host, and we'll be back next week.